Hey everyone, Warren here. Today we're doing a live dive analysis of Health and Tech ticker HIT or HIT, currently trading at $2.18 per share. This stock has been crushed, down over 65% from its highs, but that's exactly when the best opportunities often present themselves. This is a stock that's got growth investors excited with compelling fundamentals, but also has a fundamental analyst raising serious red flags about financial management. The question is, at $2.18 a share, are we looking at a beaten down bargain or a value trap waiting to happen? I'm going to show you exactly how I research a controversial microcap, share my screen with real-time Seeking Alpha and Morningstar data, and give you my honest assessment on whether HIT deserves a spot in your portfolio at these levels. Demolish. Let's address the obvious first. HIT has been falling from highs around $7 a share to today's price of $2.18. As you can see, this is the 1-year chart. This is a recent IPO at the end of 2024. The stock traded up to about $7 and then it had a 69% decline from the peak. The stock has been in a free fall since hitting those highs, but it has recently recovered here from late June on till now. What is concerning is that this decline has happened on relatively low volume, as you can see the volume chart, which suggests either a lack of interest or controlled selling. The average daily volume is low, making this an extreme illiquid stock. Looking at the news flow on Seeking Alpha, there hasn't been any major negative announcements that would justify this decline here. If you look, it's around March, there wasn't any major announcement that would justify this level of decline. This could mean the market is pricing in concerns that aren't yet public, or we're seeing indiscriminate selling in microcap growth names. The last major news here was their Q1 earnings report, which showed an 86% revenue growth, which was actually positive. We have a disconnect between operational performance and stock price performance. So I'm going to pull up their recent press release here, and it's their slideshow for their earnings reports. They did have an 86% revenue growth year over year, which is phenomenal. 9.3 million was a number that initially attracted growth investors at $122 million market cap at current prices. That puts us at about a 2.2 trailing revenue. That's quite reasonable for a growing B2B tech company. Looking at the company's profile here, Health and Tech is an insurance technology platform company. It offers a marketplace that processes in the healthcare industry. So HIT is still showing the same compelling business model as a B2B insurance technology platform, serving small businesses with faster, cheaper healthcare plan quotes. Jumping back to their slideshow, what makes HIT compelling is its speed advantage. While traditional insurers like Aetna or Blue Cross Blue Shield take weeks to provide quotes to small businesses, HIT delivers same-day responses. They built a growing network of brokers who have financial incentives to bring clients to the platform. And their management has been dropping hints about major developments, with the CFO specifically saying, keep a close eye on our press releases. But this kind of forward guidance usually indicates something significant is in the pipeline. The stock's continued decline suggests the market is either skeptical or unaware. Looking at the total addressable market for a small business health insurance, it's massive. We're talking about millions of small businesses that need better, faster solutions than what legacy insurers provide. It is a large market here, which is great for the stock. Now let's address what has fundamental analysts worried about, because at $2.18, we need to understand if we are going to be catching a falling knife here. Here's one concerning pattern. Here is a loan that I identified. HIT made a loan to a Chinese entity representing about 50% of their cash. Then within 2 months, they needed to resort to a 40% APR loan, accounts receivable, factoring for emergency cash. Looking at the most recent balance sheet on Morningstar, cash and equivalents are around $7.5 million. For a company burning cash and needing expensive financing, this isn't a lot of runway. At current burn rates, they might have 6 to 12 months of cash left, which is a major red flag for me. And along with needing the loan, it is problem that we need to think about. The high cost factoring arrangement is particularly troubling. Companies typically only use 40% APR financing when they're desperate or can't access traditional credit markets. This raises questions about either their credit worthiness or management's financial planning. Another concern is extreme volatility we're seeing with the stocks. Daily moves of 10 to 20% are common, suggests this stock is being treated more like a speculation than an investment. Moving on to Seeking Alpha here. The valuation compared to their peers, comparing to other B2B insurance tech companies trading at 6 to 10 times revenue, and suddenly HIT looks potentially undervalued if the growth story continues and if they can fix their financing issue. If we use a PEG type analysis, which you can see here, it's not calculated, but if we take the 2.2 price to sales ratio against an 86% revenue growth, we get a ratio of about 0.025, which would suggest significant undervaluation if the growth is sustainable. Let's evaluate what we can about management quality. Because in microcap, this is often the determining factor between success and failure. Inside ownership compared to the peers here is 76%, which you can see over here, these stocks are the highest is 28%. So that is significant, which aligns management interest with shareholders. However, the questionable financing decisions we've discussed raise serious concerns about capital allocation discipline. The fact that management has been hinting at major announcements that the stock has still collapsed suggests either the market doesn't believe their promises, there are issues we don't know about yet, microcap stocks are just being indiscriminately sold. From a business quality standpoint, the value proposition, faster, cheaper insurance quotes is solid, but execution risk is high, especially if they can't secure reasonable financing to fund growth. The bull case at $2.18 valuation is now attractive at 2.2x revenue. Growth story remains intact, the 86% revenue growth, market cap of only $120 million for a growing B2B tech company, potential for 3 to 5x returns if execution improves. Bear case at $2.18, financing issues could lead to further dilution of distressed sale. Cash runway may be limited to 6 to 12 months only. Management's capital allocation track record is concerning. The stock is illiquid, making position sizing critical. My specific recommendation, again, this is not financial advice. Please do your own research, but position size maximum 1 to 2% of your portfolio, treating this as a high risk speculation. Entry strategy, current level at 218. It would be good to take a small initial position of 0.5 to 1%. Dollar cost averaging, add on further weakness to $1.80 to $2 if fundamentals remain intact. Stop loss at $1.50, which is 30% below current levels. Catalyst to watch. Next earnings report, need to see continued revenue growth. Any announcements about refinancing away from high cost debt. The significant product launches management has hinted at, cash flow improvement or additional financing announcements. Red flags for immediate exit would be revenue growth below 40%, cash runway dropping below 6 months without a financing plan, any dilutive equity raises above 20% of shares outstanding, management departures or governance issues. If you're considering HIT at these levels, here's your action plan. Before investing, contact investors relations about the Chinese entity loan and refinancing plans. Review their most recent 10Q filing for updated cash positions and set up price alerts for key levels, $1.50 stop and $3 for your first target. Position management, start small, 0.5% max. Be prepared for 20 to 30% daily volatility. Have a clear exit plan for both upside and downside. Monitoring schedule, weekly, check for any press releases or SEC filings. Monthly, review cash burn and runway calculations. And quarterly, reassess growth trajectory and competitive position. Remember, at $2.18, we're essentially betting that management can execute on their growth plans while fixing their financial issues. That's a big if. That requires careful position sizing. Bottom line, health and tech HIT at 218 represents a classic high-risk, high-reward microcap situation. The valuation is now attractive, but the execution risk have increased due to their financing constraints. This is not a stock for beginners or anyone who can't handle extreme volatility, but for experienced investors willing to take a small speculative bet, the risk-reward at current levels is more compelling than it was at $6 plus. My take: consider a small position, 1% max, with tight risk management, but be prepared for this to either double or go to zero. Sometimes the best opportunities come disguised as disasters. So I want to hear from you. What do you think? Is 218 a price that can overcome these red flags? Let me know in the comments. Please let me know in the comments.
Stack it up real high. Come here to be in the know. Come here, enjoy the show. 'Cause it's Warren's money time.
If this analysis was helpful, please like and subscribe for more real-time microcap research or other stock research. This is exactly how I evaluate every speculative position, and I'll keep sharing my process with you. Thanks for watching, and I'll see you in the next one.